Money feels neutral. It feels boring. It feels like numbers on a screen or paper in your wallet. But what if I told you money has always been a weapon, a tool of control, and sometimes even a quiet form of violence? What if the system you trust every day was built on wars, broken promises, and power games that still shape your life right now? This is not a feel-good story. This is the dark history of money, and once you see it, you may never look at a dollar the same way again. Welcome to Meta Finance Lab, where you can get more informative videos related to finance. You can subscribe to the channel for timely updates. To understand money, we have to go back to a time before banks, before credit cards, before apps. Early humans traded directly. You had grain, I had tools, and we exchanged. Simple, right? But barter had limits. What if I didn't want your grain today? What if I needed shoes, not wheat? This friction slowed societies down, and that problem quietly set the stage for something far more powerful than trade itself. Gold and silver didn't become money because they were shiny. They became money because rulers could control them. Ancient kings realized that if they controlled metal mines, they controlled armies, food, and loyalty. Coins were stamped with faces of emperors to send a message. This value comes from power. But here's the twist most people miss. Gold itself had no magic. Trust did. And whoever controlled trust, controlled everything else. The Roman Empire gives us a perfect example. At its height, Rome paid soldiers with silver coins. As wars expanded and costs exploded, emperors quietly reduced the silver content in coins. The coins looked the same, but were worth less. Soldiers didn't notice at first, merchants did. Prices rose, trust fell. Inflation wasn't invented by modern governments. Rome collapsed partly because it printed money without calling it printing. Here's where the story gets uncomfortable. Every major empire repeated this trick. China did it with paper money centuries before Europe. Medieval kings clipped coins to stretch budgets. Each time, the promise was stability. Each time, the result was chaos. People lost savings. Trade slowed. Violence followed. But rulers learned something crucial. Money could be manipulated quietly, long before people noticed the damage. Then came banks, and everything changed. Not the friendly banks you imagine today, but ruthless institutions that lent money to kings. If a king couldn't repay, banks took land, power, and influence. The Medici family didn't rule Florence with swords, they ruled with credit. This is the moment money stopped being just a medium of exchange and became a system of leverage. And once leverage exists, collapse is never far behind. You might think gold kept things honest. That's the myth. Gold standards didn't stop greed. They concentrated it. Only a few institutions controlled gold reserves. When panic hit, people rushed to convert paper into metal. Banks couldn't keep up. They failed. The wealthy escaped first. Ordinary people were left holding worthless paper. Sound familiar? It should, because the same pattern repeats again and again. Fast forward to the 1600s and 1700s, governments discovered bonds. Instead of taxing citizens directly for wars, they borrowed from them. On paper, this sounded fair. In reality, wars became easier to start because the pain was delayed. Debt grew quietly, interest piled up, entire generations paid for wars they never voted for. Money didn't just fund war, it normalized it. A single authority managing money responsibly. But here's the cliffhanger most textbooks avoid. Central banks were created not to protect people, but to protect the system. When banks failed, central banks stepped in. When governments overspent, central banks smoothed it over. Stability was promised, but at the cost of transparency. And transparency is where trust begins to die. The gold standard officially tied money to something physical, but it also tied economies to scarcity. So people starved, businesses failed, and unemployment soared. The Great Depression wasn't just a market crash, it was a monetary trap. And the fix that followed would permanently change money forever. In 1971, the United States quietly ended the gold standard. No public vote, no dramatic announcement, just a policy shift. Critics warned of disaster, supporters promised flexibility and growth. Both were right, growth exploded, debt exploded faster. And for the first time in history, money could be created without a physical limit. Here's the part most people don't realize. When money is created from debt, someone must always owe. Your mortgage, Your student loan, your credit card balance are not side effects. They are features. The system requires borrowers to function. And when borrowing slows, panic begins. That's why recessions feel sudden and brutal. The system isn't breaking, it's revealing itself. Credit cards turn future income into present spending. They felt empowering. Swipe now, worrying later. But later always comes. Interest compounds quietly, just like power. By the time people realize the cost, they're trapped. The average household debt didn't rise by accident. It rose by design. And once debt becomes normal, questioning it feels radical. Then came the 2008 financial crisis. Banks packaged bad loans, sold them as safe investments, and collected fees either way. When it collapsed, governments stepped in. Trillions were created overnight. Banks were saved, people were not, homes were lost, jobs vanished. And the message was clear, even if no one said it out loud: some institutions are too powerful to fail. You'd think that would change everything. It didn't. It taught the system a new lesson. Risk could be socialized, profits could stay private, and ordinary people would absorb the shock. Trust eroded further, but participation continued. Why? Because opting out feels impossible when your entire life is priced in the same currency. Now we live in the age of digital money. Numbers on screens move faster than ever. High-frequency trading executes decisions in milliseconds. Algorithms, not humans, shape markets. But the core logic hasn't changed. Control the flow of money, and you control behavior. Spend more, save less. Work longer, borrow earlier, retire later. The system hums quietly in the background. Cryptocurrencies emerged as a rebellion against this, a promise of decentralized trust. No central authority, no printing at will, just code. But even here, power reappeared. Early adopters gained massive influence. Exchanges became gatekeepers. Speculation replaced utility. The dream was pure. The reality became familiar. Technology changes. Human incentives do not. So where does that leave us today? With record debt levels, shrinking purchasing power, and rising inequality. The numbers are shocking. In just decades, the value of money has eroded while asset prices soared. Those who own assets get richer. Those who earn wages fall behind. This isn't accidental. It's the natural outcome of how money is created and distributed. Here's the most uncomfortable truth. Money reflects values. When a system rewards speculation over production, debt over savings, and speed over stability, outcomes follow. People feel anxious not because they're bad with money, but because the rules changed without their consent. And the scariest part is how normal this now feels. History shows us 3 repeating lessons. First, money always drifts away from its original purpose. Second, concentration of control leads to instability. Third, every fix creates new problems. Gold failed, fiat created debt. Digital money raises surveillance risks. There is no perfect system, only trade-offs we must understand clearly. The warning is simple but powerful. If you don't understand money, you serve it. If you do understand it, you can at least see the traps. Awareness doesn't make you rich overnight, it makes you harder to exploit. And that alone changes how you move through the financial world. So what are the takeaways? First, money is not neutral. It is shaped by power. Second, debt is not a personal failure, it is systemic. Third, financial literacy is no longer optional. It is survival knowledge in a world built on invisible rules. The open question remains: will the next evolution of money bring freedom or deeper control? History suggests the answer depends less on technology and more on who holds the power to shape it. That decision is happening right now, whether we're paying attention or not. Meta Finance Lab brings you useful knowledge and insights to help you understand the world of finance. Subscribe to stay informed and share with others who need this information.